All right, so this is the question. We just dealt with the first part during the first year of the contract. The main goal of this question is on how to deal with the changes on the consumer price index, right? That's why they are asking during the first day of the contract and on the first day of the second year of the contract. That means there might be a need to reinstate the lease liability because there seems to be variable payments when the consumer price index changes. And so it happened from 125 at the beginning to 140 1 year later, 12 months later. So it changed from 125 to 140, right? Okay. So we just have to proceed with that. Let's go back to our quest to our solution. Just understanding number 5. It was number 5. Number 5 is, yeah, this was the solution. Yes, the first day of the second year now. Now let's be careful here. It's just like the first scenario, but there have been some changes. Now let's be careful here. There are 3 remaining payments to make, right? You know, they are speaking of the first day of the second year. On the first day of the second year, it means that there are 3 more payments to make, right? No issue with that. So we presume that the first day of the second year has just arrived. Some payment is there, and actually nothing has already been paid. It's about to be paid, but maybe it is not yet paid. It really depends on how you have decided to do it, right? Since there have been some changes, we presume that nothing has been paid. Okay, but even if you presume something to have been paid, it will just depend on how you do the accounting treatment. Okay, so we say that the payment for the second year that is now due is 1.12. How did you obtain 1.12? How did you obtain that? You know, the payment was only 1 million, but we were told that the payments will be based on the increase of the consumer price index in the last 12 months. From the last 12 months, it has increased from 125 to 140. Is that right? From what I'm repeating again, it has increased from 125 to 140. You can just make the computation there and find out. From 125 to 140, what is the difference? Just ignore this. Ignore that, you know, sometimes it might be difficult to understand what they have written here. But all we know is that it has increased from 125. Let's write down this. It has increased from 125 to 140. So it's 140 minus 125, and we get the difference of 15, right? So it has increased by 15. All right. What percentage of increase is this? Percentage of increase, initially it was 125, but now it is 15. So you could say 15 over 125 is how much percent? You can just know the percentage now. What is the percentage here? If you multiply by 100%, it could be how much? It's like 12, some kind of 12%. So it's like the 12% has increased. So if you have increased by 12%, presuming that we moved from 125, which was 100%, right now it would give 112 per what percent. So our amount, which was 1 million now, has to be multiplied by 112%. So 112% this way times 1 million, and this one would give us 1.12 million, just like this. So this now will be a new cash flow, right? Or maybe easily dealing with the concept of price index, you could just use this way. You just eliminate that previous index, which is 125. So you could just take 1 over 125 and you multiply by the new one, by the new index. You can just do it that way and simplify matters for convenience in an exam, right? Instead of going this way. Okay. So I could say lease payments now will be 1.12, 1.12, and 1.12 for the remaining years. Now we are at the first day of the second year. If we're at the first day of the second year, remember this is the payment at the beginning of the second year again. So it's like there is no need to discount it. Discounting it going where? We are at the beginning of the first year, second year, and this first payment is at that same date. But at the beginning of the third year, it means that you have to go back 1 year to reach the beginning of the second year. So that's why we discounted by 1. That's why you just see 1.05 here. At the beginning of the fourth year to the beginning of the second year, you have to go back 2 years. So that's why you have 2 here. So just multiply the cash flows, which are the future payments, multiply by the discount rate, and we have the present value just like before. Add them up to obtain the total present value of the lease payments, and this would give you the lease liability, right? Okay, so you find out that, oh, so that lease of liability of mine, which was initially how much? This was the closing lease liability, 2.86, and it was based on the remaining 3 years, is now based on the same 3 years, but it has to be changed. From 2.86 above to 3.21, you find out that there is a difference of 0.35, and that's so the lease liability has to be increased by that amount. So the lease liability is of a credit nature, so to increase it, you have to debit but to credit by 0.35 million. If we had to reduce it, then we would have had to debit the lease liability. So as I told you, if you adjust the lease liability, you also have to adjust the right of use asset. So this in turn would also increase the right of use asset by 0.35 million dollars, just like that. Then after that, you just apply for it subsequently. But here there is no issue of subsequent because we are told to apply just on the first day of the second day, or just on the first day. Now, what follows here is the payment of one. Remember, the payments are made in advance, right? In our case here, we would have said, oh, the payments are made in advance. So since they are made in advance, there is no need, just like before, to include this cash flow of 1.12 million. Of course, we would have been very, very right. We could have said, no, we don't do this. But since we included it this way, just so as to match it with the above section, we now say that at the same beginning, a lease payment has to be made. The payment of how much now is 1.12 has to be paid immediately. So to pay this amount immediately, the company will have to splash out cash of 1.12 million this way by crediting that, and then this would reduce the lease liability by 1.12 million again, just like this. I could say that, you know, we could have done this way. I need you to try this, like, so that you can see or reach the same result or not. Just presume that this cash flow did not form part of the liability because we expected to pay it. So just ignore it. You could have just ignored this 1.12 above here. You could have just ignored it this way. This one would be the lease liability. The lease liability would be actually in deficit of 1.12, right? Because if you find out here, we use 3.21, but we have to reduce it down here by 1.12. Now just presume that you had already deducted that and see what you get at the end, right? Okay, so after this, you just have your balance now. So the right of use assets carrying amount would change actually, right? Because we have increased it by 0.35. So it would be the carrying amount remaining, which was 2.79 plus 0.35, which would give us 3.14. We had it here at the end of year one. We had the right of use asset at the end of year one is 2.79 here. So since it has increased, we just also increase it. So that's what we would have done, right? And that would have depreciated just for the remaining term of the lease 33 years. But the question doesn't ask for the end of year two, it's just the beginning. So I hope you have seen how to deal with the remeasurement of the lease liability, right? Okay, if so is the case, we can just proceed now. We are done with lease accounting. We only have less accounting. So just going back here, we are reassessing the lease liability. Let's just get down here. there are some few exceptions, for lease when it comes to short life and low value assets. For lease of short life or for low value assets, we usually prevent or avoid the complications of determining the present value of lease payments and things like that. We just treat the rental payments for lease just as the normal operating expenses in the income statement, right? You just pay the lease or maybe of 1 million each year. You just debit that lease payment as an expense in the income statement, and maybe you just credit your cash and everything is done. Just like normal, just like we are used to say, oh, rent is just an expense in the income statement, right? Okay, so that's why they say that if the lease is short term, which is usually presumed to be less than 12 months at the inception date, or of a low value, then a simplified treatment is allowed. This simplified treatment is nothing need to be told. It's just the normal. Just treat the rental payment as an expense in the income statement in the period in which it is incurred. So IFRS 16 does not specify a particular monetary amount of low because how would you judge that this asset is of a low value? They usually just give some examples. It gives the following examples like tablets, usually electronic things, tablets, you have small personal computers, telephones, and maybe small items of furniture. So if you have something like that, you encounter something like this in an exam, you would presume that these are low value assets, and so there should be simplification of the application of the IFRS 16 lease standard. Okay. And then we say here that the assessment of whether an asset qualifies as having a low value must be made based on its value when new. This is something very good also. Do not say that I've lived out an item which is usually of a very high value, but since it is old, oh, the value is low, so I can just say this is a low value asset. No, you just presume when it is new, what is usually its value, and therefore a car would not qualify as a low value asset even if it was very old at the commencement of the lease, right? So let's say, oh, this car is very old. It's just like a low value asset. So I do not apply IFRS 16 here because it's a low value asset. No, that's not allowed. Strictly prohibited. Okay. So we're told that in these cases, the lessee can choose to recognize the lease payment in profit or loss on a straight line basis. We just simplify it. Just record on a straight line basis as an expense, and no lease liability or right of use asset will therefore be recognized. So no need to determine the right of use asset and lease liability. Just use the straight line basis. Let me remind something on the straight line basis, although we're just going to encounter it on the lesser accounting. But let me just remind, by straight line, they just mean it this way. Usually, let's say for year one, you expect to pay let's say 500 million. Maybe for the second year, you also expect to pay 400 million. And then at the end of the third year, you expect to pay how much? Let's presume it to be, let's say 300 million, something like that. Just like something like this, right? Let's say this is the case. If you have to pay something like this, by saying this straight line basis, you can just make a decision to determine the total value, yeah, which would be 1,200 million, and then you just count half 3 years. So you just take the average. So if you just take the average here, it would be 1,200 million over 3, which would give you 400 million, right? So if you go to the income statement and try to apply something like this, how would you proceed? Let's say for year one, what would you have done for year one? Yes, for year one, you would ask yourself, remember these are payments. You paid 500 million year one, 400 million year two, and 300 million year three. As for year one, I would say that I splashed out the cash of how much? I splashed out the cash of 500 million. So I credited cash. How much? 500 million, just like this. But really, this average amount is the expense that we expect. So this is the expense that we expect to be in the statement of profit or loss. So in my statement of profit or loss to be an expense, it has to be of a debit nature. So I would say debit the statement of profit or loss by how much? By 4 million. Now ask yourself, after doing this, these matters haven't balanced. How are you going to proceed so that the matters balance themselves? It's obvious that I have to add on debit side by 100 million. So I would say debit by 100 million, but what would this be now? It's obvious that an expense was only 400 million, but I actually paid 500 million. So it's like I paid more than what I had incurred. So if you paid more than what we have incurred, it seemed that there was a prepayment, right? So I could say there is a prepayment or prepaid expense of 100 million. So if you just do remember from the concept of Web 3 of financial accounting, you just need to know about the prepaid expenses. It would be this way. This was for year one. As for year two, actually, what would you have said? As for year two, as usual, I would say I have the same expense of four. Let's change. Suppose it was year two here. I would say I have an expense of, first of all, I paid, this is the cash. I paid 400 million, so I credited cash by 400 million. Very fine. What was my expense again? My expense was the same, the average value of 400 million. So debit the statement of profit off by 400 million. This one would have balanced, and so there would have been no prepayment, just that way. Okay, now let's presume that we are at the end of year three. At the end of year three, I would say as usual, what cash did I splash out? I splashed out the cash of 300 million, right? Okay, so I would say I splashed out the cash. I purchased cash of 300 million. Then what am I saying? What was my expense? My expense was only 400 million. So it's the usual expense is 400 million. Now ask yourself, you know, when you record an expense when it is incurred, not necessarily when paid, right? So here I would say that I have incurred an expense of 400 million, but I've only paid 300 million. That means I still owe the lesser. So if I still owe, I say that I have an accrued expense. So I would credit here something called an accrued, or you could just say an accrued expense of how much amount of 100 million, just like that. You see, this time you can just go back to the concept of accruals and the prepayments. Maybe I could try to share later the video of accruals and prepayments. I just prepared it several years ago. I could just share it so that you go through it, right? So you won't believe it, my friends. We have, by just doing this, when you read the lesser accounting, you will find out that you have already started with one of the parts. All right, let me clear this and then we can proceed. Let's go to the Lease disclosures now. Lease disclosures. What do you disclose? About disclosure is usually something very normal. What you did when computing those lease liabilities, right of use assets is what you disclose. So it's usually nothing, right? Let's just go through it faster. So Lease disclosures. If the right of use assets are not presented separately on the face of the statement of financial position, then they should be included within the line item that would have been used if the assets were owned. Rights. Do you see this? I don't know if you just got me. When you dealt with the right, when you started dealing with the right of use assets, we say that the right of use assets are usually measured at cost model. Let me be clear on this, right? I just need us to go slow on this. I don't need to rush, no need to rush. Let's just go slow because this standard needs a lot of explanations. Right of use assets are usually measured using the cost model, right? In the cost model, as you saw, you just take the cost, you minus the residual value, divide by the remaining by the useful life, right? Or maybe the lease term, depends which is the shorter. But we just gave examples, for example, for I-40, which is investment property, that let's say that, properties rented the buildings. Let's say that, or not just saying, for investment property, we usually have cost model, or we have the fair value model. So we have the cost model, or we have the fair value model, just like this. We have to choose. But when dealing with investment property, for example, investment property means land or building. So if you just say this land or this building will be based on the fair value model, that means you cannot use the cost model. You cannot use the cost one, the cost model. So in that case, even if maybe you have another property, but you obtained it under lease, you can decide, oh, I'm not going to use the cost model. Let me combine that with the fair value model. I'll also use the fair value model. So in that case, you might just put the right of use asset as part of the investment property. Instead of saying in the statement of financial position that I have the right of use asset, but also I have the investment property. Instead of you can just say, oh, no, 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 no. Let me just write investment property as a single line item. Investment what? Property. If you just do the same base. So just write investment property and just ignore all of the remaining two things, right? It's just like this. No big deal, right? Yes, yes. Okay, so I hope you got what was just being talked of. All right, the entity now must disclose which line item includes the right of use assets. So if you find out that there was lease, but there is no word right of use assets, it has to be specified whether you've included it in under investment property, maybe it was under property, plant and equipment over 16. Just specify, oh, the right of use assets are included under the PPE section, right? Just specify. Okay, so IFRS 16 requires the leases to disclose the following amount. This also is something normal. Depreciation charge on the right of use assets, as we saw. Interest expense on lease liability, we determine the interest expense and finance cost. The expense relating to short-term leases, maybe those short-term leases, and there was that expense. Obviously, it should go to the income statement, but you have to specify it. Cash outflows for leased assets. There's an asset that was leased out. Maybe you have paid something, so just specify the range of paid, which if you find on that amortization table spoke of everything, we have an open balance, then the finance cost, which is interest expense, then less the payment. That's what they're talking of here. Right of use asset addition, maybe if you had new leases, you just have to write the right of use asset addition, maybe the carrying amount of right of use assets. It's just the list, right, on how we are measuring right of use asset and the lease liability. A maturity analysis of lease liability. Just show that amortization table, right? So it's something you would have to show. All right, now we go to the lesser accounting. Okay, I think we spoke about all these in the previous section. We skipped and came to finance lease and operating lease to distinguish them first, but no issue. We could just go through again. So we have lesser accounting here. Now, in a lease, it's a contract that involves two parties. The lessor, actually, the one that is going to have an underlying asset in exchange for the payments of the consideration, and that's the lessee, but also the lessor. The lessor, the one giving out that property so as to receive consideration. So under lessee accounting, there is no need to differentiate between finance lease and operating lease. But under lessor accounting, you have to differentiate the two, right? Why right now no need to distinguish on the lessee? As for the lessee, most lessees we are just trying to make the lease similar to the operating lease so as to avoid the financial obligations, so as to do the off-balance sheet financing, because the obligations are not being seen in the statement of financial position. But right now, since the lessor are the one financing the leases, they are just free. They can just decide whether it is a finance lease or operating lease and act accordingly in different ways. Okay, so that's why under lessor accounting, there comes a distinction between finance lease and operating lease. Now, we will start defining the finance lease, and the operating lease is something other than the finance lease. So finance lease is a lease whereby substantially all of the risks here, substantially all of the risks and the rewards of the underlying asset transfer to the lessee. Maybe I try to explain this in simple terms. Sometimes these matters become very difficult. We'll have to see some examples, but when we speak of the finance lease, it's like the lessor has bought something maybe. After leasing it out, they expect to recoup almost everything. They do not worry about anything. They just know that they recoup all the investment plus actually further returns. If you just read the question, you just read the explanations, and you find out that logically, no lessor would be fine, would be content with making this decision while they are not recouping all their cost, but also some additional returns. Just know that the finance lease, right? And that's why an operating lease is a lease that does not meet the definition of a finance lease. So simply speaking, just check for the condition of finance lease. They are not met, then consider it an operating lease, just like that. All right. How do we do it on operating lease? Just simple, just like how we dealt with the short value assets, short value, short low value assets and the short life assets. How to classify a lease now? Now, how to classify a lease would actually base the finance lease. So if the following conditions are fine, this would be probably a finance lease. Not necessarily all, right? Okay, so for example, ownership is transferred to the lessee at the end of the lease. Just presume that someone has leased out a machine to you, maybe for 5 years. The machine has a useful life of 10 years. But after 5 years, they would just give you that asset. Ownership would transfer to you. You know, they are not stupid. They are not stupid to incur cost to own something and then just to sell 5 years and to give it to you. What they believe is within those 5 years, the rent you are paying them, actually that rent compensates for all the costs they incurred plus additional benefits, right? That's why if you find out something like this, just make judgment. Would this guy be ready to do this? No. They are doing this because they have already recouped what they required. Okay. The other point here, we say that the lessee has the option to purchase the asset for less than its expected fair value at the date of the option becomes exercisable and is reasonably certain the option will be exercised. This also makes a lot of sense. Let me give you an example. Today, maybe you need a machine, you actually don't have it. You go to the lessor leases it out to you, and you have that machine. You know, you stay that machine maybe for 10 years, but after 10 years, maybe, you are given the option to purchase it for $15 million, while you find out that $15 million, only $15 million, while the fair value after 10 years is expected to be $100 million. You find out that this letter is not stupid. They cannot just sell something to me for $15 million while it is actually worth $100 million. They are doing this because they believe that after 10 years, they would have recouped sufficient amount. So it's like a finance lease, right? It's like something someone is giving to you, but it's like you have already compensated for all of that cost. Okay, so this is just another example. And then you have something like this. The lease term, including secondary periods, is for the major part of the asset's economic life. Just presume. You are given the question, the asset has a useful life for 25 years. You are told that initially you will lease it for 10 years, but actually they could give you an additional 14 years, giving you a total of 24 years. You ask yourself again, would this guy be ready to lease me out for the secondary period so that I stay with the asset almost for its entire life while they're not getting any benefit that compensates them? We say no, that's not possible. They really believe that if they lease it out for the second time to you, that one would be sufficient actually to give them their returns, but also to cover for the cost they initially incurred in acquiring that asset, right? Okay, so these are the examples. So it's something that you just take a look and judge. Of course, the examples you can just look at because they are the same on an exam, but also it's nice to make your own judgment. It becomes very nice. Okay, let's proceed here. Another example is say that at inception of the lease, the present value of the lease payments amounts to at least substantially all of the fair value of the lease asset. You know, we are just trying to make judgment at different points in time of the lease arrangement. For example, we just took a look maybe at the end of the lease, the life of the lease. And right now we are at the beginning. Now listen, At the beginning of the lease, let's say, at the beginning of the lease, you find out that, oh, at the beginning of this lease, at the inception, this asset is worth $10 million. But you ask yourself, I'm going to stay this asset for 5 years and I'll be paying $3 million each year. That gives $15 million. Even if we discount it, maybe it could be $11 million. So you find out that, oh, so essentially maybe right now I'm not financially fine, but in reality, the present value of what I expect to pay in the future can actually cover the full amount of this fair value of this asset now. So if it's something like that, you really believe that, oh, this is just like a finance lease. It's like I'm purchasing it. Actually, it's like it's mine, but I just don't have those funds. So you just take a look at the benefit the lessor gets. If you see that the lessor gets every benefit, everything, so you say this is a finance lease. Else, you call it an operating lease. Another point here is say that the leased assets are of a specialized nature so that only the lessee can use them without major modifications being made. This is also actually another fine example, right? You lease an asset of a specialized nature so that only the lessee can use them. Someone gives you the assets, which is actually very specialized. That means not just anyone can find it useful. They have just given it to you, and only you maybe can use them without major modification. If they go to other guys, actually they need major modification, they would have to modify them at a very high cost. So we find out that when they leave them to you, they expect to get all of their money back, right? Okay. Actually, these examples just proceed, go on and go on, but let's just take a look at all of them now. Let's just proceed with stride. The lessee will compensate the lessor for the losses if the lease is cancelled. Now find out something like this. If you just read at this question, these explanations, it's like they all favor the lessor. Just read at them. It's like the lessee encounters a lot of problems to compensate the lessor, right? Lessee will compensate the lessor. So you have taken the machine from someone, but also maybe in case of anything, maybe you can't say the lease, you would have to pay them. It's like you've compensated for them already, right? So these are just examples. Maybe you have something else here, gains or losses from fluctuations in the fair value of the residual fall to the lessee. Gains or losses fall to the lessee, for example, by means of a rebate of lease payments. Now do you see this? Gains or losses from fluctuations in the fair value of the residual. You know, let's say that you expect the asset after the end of the lease term to be worth 10 million, but actually whether that increases or whether that falls is up to the what? Is up to the lessee. So the lessee carries those issues. So it means that the lessor is just still free. The lessor is safe. So just when we see the lessor is safe, this becomes a finance lease. In the last point now, the lessee can continue the lease for the secondary period in exchange for substantially lower than market rental payments. Another very important point, you ask yourself, maybe the asset has a useful life of 20 years. Initially, the lease is for 5 years only, but the lessee is given an option for the remaining 15 years after those 5 years, maybe to pay only $5 million each year, while the market value is actually $15 million. You find out why. How would the lessor, the owner of the asset, be ready to give you something like this? They are just ready to give something like this because they believe that they know that they have already recouped enough. So they don't need to hassle a lot in convincing you, right? That's why we say that in this standard here, we prioritize the substance over form. We just take a look, we just consider the economic reality rather than the mere legal form, right? So this is the situation we have to go through. Okay, now something like this. We have about just 4 minutes and then it would end and then we go to finance leases. Maybe let's just try to take a look here. The question says Dan Bob is a lessor and is drawing up the lease agreement for a building. The building has a remaining useful life of 10-50 years. Okay. The lease term, which would commence on 1st January, is for 30 years. Just taking a look at these years, we find out that, oh, the lease is only for 30 years, but the remaining life of 50 years. Is it a finance lease or not? We can just say, oh, maybe it's not a finance lease because no condition for finance lease because it seems that the lease, the remaining life is a lot. So we still expect the lessor to get back their building and to recoup much more from others, right? So the lessor is still at a disadvantage. They cannot get everything from the lessee, so it's not a finance lease. They can just proceed with the other concepts. Dan Bob would receive 40% of the asset's value upfront from the lessee. So there is some that is given in advance. At the end of each of 30 years, at the end of each of 30 years, Dan Bob will receive 6% of the asset's fair value is at 1st January 2024, but also legal title at the end of the lease remains with Dan Bob. Dan Bob remains the legal title. So this also shows that it's not a finance lease. So you have to take a look at each very concept. But the lessee can continue to lease the asset indefinitely at a rental that is substantially below its market value. Do you see this? The lessee can continue staying in the asset even though it's not owned by them, but they will stay the asset indefinitely. That means for its entire life. So this concept of 50 years is no longer relevant because it's only for 30 years, but they can stay with this. So is it reasonable that they will exercise that or not? Because they can continue, they only have that option. Okay. If the lessee cancels the lease, it must make a payment to Dan Bob to recover the remaining investment. Now you see this. The lessor is actually very, very safe. If the lessee cancels, they would have to compensate that. So just take a look at the conditions, explain one by one, and then reach the conclusion. By IFRS 16 leases, now you are asked, should the lease be classified as operating lease or finance lease? That's number 6. Now you can just take a look at this and make a decision. Now, you start explaining in an exam each point after another. A finance lease is defined as, I think you already specified that. Just take a look at the benefits of the lessor. It's just the key indications now. The lease transfers ownership of the asset to the lessee by the end of the lease term. So this indicates the finance lease. As we said, the lease term is for the major part of the asset's economic life. Initially, it was only 30 years, so we said it's not. But we said that it could be transferred. So if transferred, it would now be for the major part of the asset's life because they said indefinitely. And then they say at the inception of the lease, the present value of lease payments amounts to at least substantially of the fair value of the lease asset. Actually, could not speak much because they only say 40, it was 40%, right? If it's not very specific, just look at the point that they are very specific. And here we say that the lessee can continue to lease the asset for the secondary period in exchange for a lower amount of market rental payments, which that favors it. And then here at the end, the lease term is only for 60%, 30 years. I think we explained this already. It seemed to be an operating lease, but there was a change that they could stay with the asset indefinitely. So I think we are just reaching at the point of the finance lease, right? So all things considered, it would appear to be a finance lease, right? Okay, so the session is about to end again. It just ends.